There's a sneaky tax trap that catches a lot of retirees off guard. And the worst part is, it doesn't show up until years after you've left work. By the time you realize what happened, it's often too late to fix. But if you know about it before you retire, you can actually use it to your advantage. In this video, I'll show you how the retirement tax trap works, why it catches so many people by surprise, and what you can do in your 60s to avoid it. This one strategy alone can save you tens of thousands of dollars over the course of your retirement. I'm Kerry Green, financial advisor and co-founder of Green Era Financial, and I help people close to or in retirement to get the most out of life with their money, and that includes staying ahead of unnecessary taxes. So let's get into it. The trap starts with how your income flows change once you retire. When you stop working, your taxable income usually drops, sometimes by a lot. You're no longer earning a salary, you might not even be taking Social Security yet, and if you don't have to take anything out of your retirement accounts, you might be in the lowest tax bracket you've been in decades. But fast forward 5 or 10 years, and everything flips. At age 73, required minimum distributions, or RMDs, kick in. That means the IRS forces you to start pulling money out of your tax-deferred accounts, like 401ks and traditional IRAs, whether you need to or not. And those RMDs can grow quickly. It's not uncommon to see someone go from a 12% tax bracket in their early 60s to 22 or even 32% bracket by their 70s. It's what we call the retirement tax curve. Low taxes early, high taxes later, and if you're not planning around that shift, it can lead to surprise tax bills, higher Medicare premiums, and even taxation of your Social Security benefits. But here's the good news. There's a planning window in your 60s that can make a massive difference, and most people miss it entirely. If you retire at, say, age 62, and you don't take Social Security until 67 or 70, and you're not forced to take RMDs until 73, then you have this 5 to 10 years of generally low taxable income. And that window is golden because you can use those years to do things like Roth conversions, strategically moving money from your traditional IRA to your Roth IRA, paying taxes at today's lower rate and letting it grow tax-free from there. Or you can harvest capital gains in your taxable accounts while staying in a 0% capital gains bracket. Or you can delay Social Security and reduce the numbers of years it's subject to taxation. This is one of those areas where proactive tax planning pays off in a big way on your lifetime tax bill. Now let's talk more about Roth conversions. When you convert money from a pre-tax IRA to a Roth IRA, you pay tax on the amount you convert in the year of the conversion. That adds to your taxable income. But if you're in a low bracket, that can be an opportunity. For example, let's say you're married, filing jointly, and your taxable income is $50,000 in a given year. That leaves you room to do a Roth conversion and still stay within the 12% tax bracket. Now fast forward to age 73. Your RMDs kick in and push you into the 22 or 24% bracket. And now you have fewer options to reduce your taxes at that point. So converting at 12% today can be a lot better than being forced to withdraw and pay 22% later. It's also worth noting, Roth IRAs don't have RMDs during your lifetime, so you retain more control over your income and tax exposure. This isn't just about income taxes. Higher income later in retirement can push you over the IRMA thresholds, which means you'll pay more for Medicare Part B and D. It can also cause more of your Social Security benefits to become taxable. If you're married and your combined income exceeds $44,000, up to 85% of your benefits can be taxed. So by keeping your income low in later years through early Roth conversions, withdrawal planning, and account diversification, you can reduce not just your tax bill, but your Medicare premiums and Social Security taxation too. So if you're in your early 60s or even your late 50s, this is the time to start modeling your retirement tax curve. And here's what I suggest. Number 1, look at your projected income year by year from retirement through age 75. Number 2, identify low-income years where you could potentially fill up lower tax brackets with Roth conversions. 3, work with a financial planner, or at least use a really good software to map out how withdrawals, conversions, and Social Security will interact. And 4, don't just focus on minimizing taxes this year. Look at your lifetime tax liability and optimize for that. This is the kind of planning that doesn't happen automatically. Your tax preparer isn't going to do this for you. It takes proactive work, but it's absolutely worth it. The retirement tax trap is real, but it's also avoidable if you understand how your income changes over time and you use the low income years wisely. Whether it's Roth conversions, withdrawal sequencing, or delaying Social Security strategically, there are tools you can use to flatten your retirement tax curve and keep more of your hard-earned money. And if you'd like help modeling this out for your own situation, or if you want to explore a custom tax plan for retirement for you, feel free to visit us at greenarrowfinancial.com or reach out to me anytime. I'm always happy to help if I can. Thank you for watching, and I'll see you next time.